Good afternoon and good morning, everyone. Thank you so much for joining. We're going to be talking today about the Australian mandatory climate reporting and a bit of an introduction to ASRS for Group 2 reporters. So yeah, thank you so much for spending your mornings or your lunchtimes to hear a bit about that. Before we get into it, I would just like to acknowledge the traditional owners of the lands on which we meet today, which for me is the Gadigal people of the Eora Nation, and we pay our respects to elders past and present. Bit of housekeeping before we get into it. So you should all be on mute with cameras off. But if you do have any questions as we go throughout, we've got the QA function enabled, and there should be some time at the end to run through those questions. So please do start dropping those into the chat as we go. We are also recording this session, and we will make that available to everyone after the webinar. So if you have to drop off or you want to share this with any of your colleagues, you'll have that to share around as well. In terms of what we're going to cover today, so firstly, I will introduce myself and give a little bit of background to SLR, but pretty quickly get into the ASRS, so an introduction to what the Australian Sustainability Reporting Standards are, but then talking mostly about what you actually need to do, bringing in some lessons learned from the first group of reporters, and hopefully giving you some guidance around how you can get started. As I said, I'm hoping to have kind of 5 minutes or so at the end for Q&A, and if you can drop your questions into the chat, we'll try and get to as many of those as we can. For those of you who don't know me, so my name is James Balik-Meacher. I lead the Climate and Nature Advisory Team at SLR across APAC. I'm based in Sydney, but I work across New Zealand, Australia, and as well as our Southeast Asia offices as well. What that means in reality is I've spent the last 18 months or so helping all of the Group 1 companies in Australia prepare for their mandatory climate reporting. So hopefully have some pretty useful insights in terms of what this means and how you can prepare for your reporting if you're in Group 2. Few stats about SLR before we get into the real content. So if you don't know SLR, we're a global environmental and sustainability consultancy. We're across all regions globally. We've got over 5,000 staff now, and a huge range of technical services through environmental, engineering, scientific, and a growing advisory team, as well as data and digital analytics. Within the APAC region, we are over 1,000 strong, with the majority of those across Australia. So a really, really strong team here, a great team over in New Zealand, and a growing team across Southeast Asia and in China as well. So for our Australian clients, what that really means is we have the people on the ground who understand your local context, but also through that growing Asia team, we've got the people that understand your value chains and your supply chains beyond the borders of Australia as well. So getting into the proper content, what is ASRS? So some of you are probably familiar with this already, but I think it's good to kind of frame up where this standard has come from, who is caught by it, and also some of the reasoning behind how it's been set up the way that it has. So the Australian Sustainability Reporting Standard is the first time that we have had broad scope standardized requirements for large businesses in Australia to report on their material climate-related risks and opportunities. And very importantly, and probably in contrast to previous legislation that you might have been captured by, this is really focused on how those risks and those opportunities can affect your financial position and your financial performance. So it's not just about managing environmental impact, it's about what does this mean for your business and your strategy going forwards as well. The purpose of this is really to embed that climate risk into your mainstream financial reporting, so the users of those financial reports can understand what this is going to mean for your business over the long term. And the way that is done is by integrating this within those financial accounts. So you will submit this sustainability report alongside the financial reports that you're required to submit under the Corporations Act to ASIC. The other thing that's really important about this is who is actually captured. And this is pretty wide ranging, and basically any company of any size within Australia is going to be caught by this, whether you are publicly listed, whether you're privately owned. It also includes superannuation funds and financial institutions as well. And there is some phasing to this dependent on the size of your organization. So not everyone is reporting straight away. That first group of companies is reporting right now. So they've been reporting on their financial years that started at the back end or the start of 2025. So those reports are starting to come out now, and we're getting some insights in terms of what that looks like. The focus for today, and hopefully most of the people on the call sit within this second group of reporters. So if you're in that second group, and there's two ways you get caught by that. The first is being an NGAS reporter. So anyone who is an NGAS reporting entity and is already reporting on your emissions will get captured. Either you're caught already or you're caught in this second group of reporters. And then there are also some financial and size thresholds that you can trigger this as well. So if you have $500 million in consolidated assets, 200 million in revenue, or 250 employees, if you get 2 of 3 of those triggers, then you have to report as part of Group 2. What that actually means is, so your first financial year that starts on or after the 1st of July this year, you will need to report on. So for Australian financial year reporters, when you get to 1st of July 2027, you'll be reporting on your previous financial year. And for calendar year reporters, you'd be reporting on 2027 calendar year. So what does this actually look like in reality? So there are a few things that they have done with this standard that I think are really important to note. The first is international alignment. So the ASRS mirrors the International Sustainability Standards Board standards. You don't need to remember that acronym, but what you should take away from that is that this is the same standard or a very similar standard to that is being mandated in Europe through CSRD, in the UK through the recently announced UK Sustainability Reporting Standards, and also broadly across Asia, including in Singapore, in Japan, in Malaysia, in the Philippines, in China, I could go on, as well as beyond that as well, LATAM, in Africa as well. They're introducing this in South Africa. So basically globally, this has become the standard. That's really important because it enables consistency. So those that are using these reports are able to compare between regions, but it also brings a lot of efficiencies for the reporters. So we're coalescing in terms of the data, the methodologies, what best practice looks like around a single standard and a single set of disclosures that people are focusing on. From a practical side, what this also means, companies that are quite often being caught in multiple jurisdictions, so multinational companies, have a lot of efficiencies when they're doing this reporting as well. So you're not having to comply with lots of different standards in lots of different places. You're able to reuse that data multiple times in multiple instances. And I know a lot of the Group 2 companies that we're working with in Australia are part of those larger global organizations that are already thinking about compliance to CSRD in Europe, for example. The second thing that this is doing is really turning sustainability from a soft nice to have to a hard regulatory piece. So what this is doing is effectively bringing the same mandates and the same consequences for financial reporting onto those sustainability disclosures. So legal liability for directors, greenwashing can potentially be prosecuted if you're putting out unsubstantiated claims, assurance requirements, so the requirement to get that third party to come and assess the validity of the claims that you are making. The same things that you would be doing with all of your other financial disclosures are now being mandated for climate as well. But what it is also enabling companies to do is actually think about this in a much more strategic way. So as well as complying with this regulation, there are lots of actually really useful insights that we're seeing companies gain by going through this process. So helping you understand across your business through the different functions how climate is going to impact you from a financial perspective, from a risk management perspective, how it's going to impact your procurement and your supply chain, how you can think about building resilience within your operations or within assets that you own, as well as pushing it up the chain to give that senior oversight both at an executive and a management level, but also board responsibility for these disclosures as well. In terms of how this is structured, so ASRS is built around 4 pillars. Those of you who have done TCFD reporting in the past may recognize these pillars, but effectively governance, metrics and targets, risk management and strategy. The governance piece is all about who's in charge, who's managing those disclosures, who's managing those risks and opportunities, and what the overall oversight and responsibility is within your organization. Metrics and targets are all of the numbers that sit behind this. That includes your emissions reporting, but it also includes other metrics and targets that you might want to disclose around how you manage those risks and potential kind of financial exposure as well. Risk management is probably the most practical piece within here. The main focus of that disclosure element is how you're integrating climate risk within your broader enterprise risk management and existing risk management processes. And then the strategy piece, which is probably the most complex and probably hopefully the most interesting piece within here as well, which is all about understanding how you're exposed to those climate-related risks and opportunities, how they're going to materialize over time, and also your strategy for managing those, including things like your transition plan that should be kind of the endpoint of this disclosure. Not all of this is disclosed at the same time and to the same level, so there is some phasing to this. The Scope 3 emissions, which is your value chain emissions, are optional within the first year of disclosure, and there is also some phasing on the assurance requirements. So I won't go through this entire table. We've got a blog that you can go and read if you want to read that. But effectively, what you need to know is everything is eventually assured to the same standard as your financial disclosures. So working through from some light touch assurance on some of the critical elements in the first year, everything being assured within that second year, and then the level of assurance ramping up over time. What that means in reality is you don't just need to do this and report on this. You need to make sure you have the systems, the governance, the processes, and the documentation in place in order to go through that assurance as well. So hopefully that was a useful little overview of what the standard is and what you're going to be required to do. There is a lot of detail in there, and the standard is quite long. There's lots of little minor points that people will need to put disclosures on. What I want to do now is take a bit of a step back and hopefully run you through a couple of elements that are really the critical things, what you're supposed to be getting out of this and how you're supposed to be using some of these disclosures as well. So beyond those kind of 4 pillars and the pieces that you actually need to disclose, the reality is there's actually 3 things that you need to do. So the first is understand the impact that your company has on climate, and ultimately that means where are your emissions coming from within your direct operations as well as within your value chain. The second thing you need to do is understand the impact that climate change is going to have on your business. So undertaking a risk and opportunity identification, using scenario analysis to understand what those risks look like and manage the uncertainty around those potential futures, and then undertake an assessment of your business's resilience to climate change. When we talk about that impact from climate, we're talking both about the impact from physical changes to the climate, as well as the impact that the response to climate change can have from a transitional perspective as well. And then the final piece of the puzzle is really the so what. So it culminates in what is called a transition plan within the disclosure, but effectively you need to put 2 things within there. One is how do you manage the impact on climate, so your decarbonisation targets and decarbonisation roadmaps, as well as how you manage the impact climate change is having on you through mitigation and adaptation measures and building resilience. So to go into those 3 pieces in a bit more detail, firstly, the impact on climate. So in terms of what you actually have to disclose, there's basically 3 things within there. The first is your Scope 1 and 2 emissions. So there's your operational emissions from buildings, assets that you own, likely fleet equipment, any other fuel that you have that you're using within your direct owned operations will be included within there. Those of you that are NGAS reporter will have 99% of that already. The other piece that you need to disclose from your second year of reporting is your Scope 3. So that's your broader value chain emissions, everything upstream from your suppliers and downstream emissions from your customers as well. Assurance is required on these disclosures from the first year that you disclose. So in year 1, you disclose scope 1 and 2, that will be assured. Year 2, you need to disclose scope 3 emissions with that same level of assurance as well. In terms of what that actually looks like, so this is a diagram that many of you will be familiar with from the Greenhouse Gas Protocol. Your scope 1, 2, and 3 emissions are basically everything that your company is doing that is impacting on climate. Scope 1 and 2 are much conceptually easier to understand and also generally easier to gather in terms of data. Those are your direct operations where you have control either over electricity or direct fuel use within your operations. Scope 3 emissions are a bit more complicated, but that will include upstream emissions from your suppliers or products that you are buying. That also includes things like business travel and employee commuting within that upstream piece. And then downstream emissions from products or your customers or investments that sit within your downstream value chain as well. So that's a little bit about what you need to disclose. A few little takeaways that hopefully is useful to see from some of the Group 1 companies we've been working with. I think that the easy answer to this is that Scope 1 and 2 is much easier. We know that, and it's where people tend to be more prepared as well and more used to this reporting. Scope 3 does take a fair amount of time to get ready. What we've seen with a lot of our Group 1 clients is that they are starting on this journey expecting to have Scope 3 ready for disclosure in their first year. But actually, once they get into it and start understanding the data requirements, they're realizing this is a 2-year process to get it to the point where it is assurable. The other thing that's really important is that documentation and methodology piece. So lots of people may have this information, maybe doing these calculations already, but once an auditor gets involved and starts poking holes in it, it can be really hard to back up some of the assumptions and some of the data that you have unless you've got really clear documentation around the assumptions, the methodologies, and the estimations that you're doing. Those assumptions and estimations are inevitable, especially for Scope 3, and I think that's okay. A lot of people worry about having perfect data, but as long as you're documenting that and making it clear how and why you've made those assumptions, then you should be fine. In terms of some practical steps, so things that you can get started with now, first piece is understand what you already have and assess that completeness. If you've got NGAs reporting, I'd say you're probably 95% of the way there. For Scope 3, get started probably now, engaging those teams, understanding the data that you'll need to do those calculations. And then finally, think about software, but as a long-term enabler. Some people come into this thinking, we'll just get a platform and it will solve all of our problems. I think now more than ever, as with the advent of AI and some of the solutions that are on offer, it's still very much rubbish in, rubbish out. If you don't have your data in order and you don't understand what you need to input, you're not going to get a good output from no matter what software you implement. So that's a bit about the impact on climate. The other piece that you need to think about is the impact that climate change is having on your business. So there are a few things that you need to work through here, and this is not an exhaustive list, but you need to think about identifying climate-related risks and opportunities, both physical impacts, as well as those transitional impacts. So how does the change to a low carbon economy impact your business in terms of the products and services that you are selling? You then need to undertake climate scenario analysis. So both a qualitative assessment of how material these risks are going to be over time and under different futures, as well as quantification of the impact those risks will have on your financial performance. Incorporated within that, there is also the requirement for a resilience assessment as well. So understanding the resilience of your business, as well as any planned or potential future mitigations that you could be putting in place. The scenario analysis piece is probably the hardest piece in all of this and the bit that takes the most time. And I'm not going to go into loads of detail here. What I will flag is we're going to be running another webinar specifically on scenario analysis to talk through how you can think about this and how you can use this within your organization. But at a very, very high level, scenario analysis is effectively a tool to manage uncertainty. So looking at a number of different potential climate futures, accepting that we don't know where we are going to be in 50, 100 years time, and thinking about how those can materialize, how those can evolve, and what the impact on your business is likely to be. So a few more insights from our Group 1 friends. There are a few things that have really stood out as we've worked through this process with those Group 1 companies. I think the first is the understanding of climate risk is patchy at best, if I'm going to be polite about it, especially thinking about those transitional risks. Most people understand how acute physical impacts could impact their organization. When you start talking about chronic physical changes and long-term changes to heat and precipitation patterns, it starts to get a little bit more murky. And then a lot of the time when you start talking about those transition risks, so thinking about technological changes or the energy transition or transitions away from fuels in heating to electric, for example, a lot of that is very poorly understood even at a conceptual level, but especially when you get into the detail of how this actually has knock-on effects to your business. So that means there is a lot to be done in terms of internal engagement and building that knowledge base. The second thing that we found is some companies go into this trying to build their own climate scenario narratives, which can be useful and it can give you more insights, but it does take a lot of time and can often lack data. What we tend to recommend is actually using some of the global standard scenarios as the basis for your assumptions and then kind of building from there. The final piece is quantification, and this is the bit that often scares people, trying to put a financial impact figure on those climate risks. This is going to be expected. And the auditors are going to be asking for it when you get to that point. But we do know actually, at least in the first year, qualitative disclosures are acceptable as long as you can back up why you haven't gone down that quantification path, whether that is capacity, uncertainty, or you haven't had the time to build that out fully. You can get away with that as a more narrative-driven piece, at least in the first year. So a few practical steps. As I said, start now. This is going to take time, minimum 6 months. I would suggest to go through this process. For most of our clients, actually, it's taken kind of up to 9 months with all of the engagement and other things that need to be done. Engage the business early. I say there will be upskilling that needs to happen, but also inputs that are needed from all sorts of different parts of the business as well. Good quality data is really, really important. There are some publicly available data sets out there that can get you some of the way, but when you really get into the nitty-gritty and especially start to try putting financial impact figures on this, the more granular, the better in terms of the data that you're using. And then the last thing, and probably the most important takeaway from this is watch Ash's webinar. So my colleague Ash Turner is going to be running a follow-up webinar on scenario analysis in about a month's time. We should have the details ready to go later this week. Make sure you sign up to that because that will be really, really useful when you get started on this scenario analysis piece. So, conscious of time, I may whiz through this section quite quickly, but the last piece that you'll need to think about is that transition plan. And as I said, this is really the so what from all of this. In terms of what you need to disclose within the first year, you need to state whether you have a transition plan. So if you don't have one, you can actually just say, no, we don't have one. But where you do have one, provide high-level details on what that plan is. That includes your management of those climate-related risks and opportunities that we just talked about. It includes your management of greenhouse gas emissions, so targets and decarbonisation strategy, as well as any disclosures around the feasibility of that strategy, including any assumptions or any external dependencies that you have. This transition plan should be ultimately something that feeds into your overarching business strategy. The decarbonisation piece is the bit that most people focus on, but that management of climate-related risks and opportunities, as well as how more broadly you're contributing to an economy-wide decarbonisation and transition, is really important for how you structure your business and actually the long-term viability in that transitioning world. So that is what you're supposed to be moving towards. A really good framework for this is the Transition Plan Task Force, which is where this diagram is stolen from. So that was developed out of the UK as a kind of gold standard for transition planning. It's being recommended by the ASRS as a best practice framework. And even if you don't use all of the elements from there, it gives you really good structure around how you build that plan and how you disclose. back to our group one friends. So a few lessons from what is being disclosed at the moment and some of our group one clients. So most companies don't have at least a complete transition plan. They might have some pieces around greenhouse gas targets and some decarbonisation pieces, but it's okay for this to be patchy in the first year. That transition plan task force that I mentioned is a really useful framework. You don't have to use the whole thing, but I would highly recommend, at least as a starting point, going through a bit of a gap analysis against what they suggest to see where you sit and what you can build out. For the first year of disclosure, having some targets and some high-level decarbonisation plans is absolutely enough, potentially more than enough to get you through that first year of disclosures. But you will be expected that this is evolving going forward. So you'll probably be required within that disclosure to state what you're planning to do. And I would describe it as a bit of a plan for a plan in terms of what comes next. And a few practical steps to take away from this. So firstly, look at what you already have. And I think this disclosure, especially this transition plans piece, can really be, this is where we are, this is what we're doing. But making sure you build out then a longer term framework, ideally around that transition plan task force piece for what that longer term plan looks like. So as I said, the focus should be disclose what you have. This is what we're doing. Year 2, year 3, year 4, you'll need to then evolve this and make this more robust. So how do you actually get started on all of this? So hopefully that was useful and a bit of an overview of everything you need to do. There are a few things that I think are really, really important for people to get started on now. First piece is engagement, and I cannot stress this enough. Engage, engage, engage. That includes your senior leadership and decision makers, the people that are going to need to be signing off on this ultimately. But it also includes those operational teams. You'll need input from across the business, from procurement, from operations, from property teams, from fleet managers. So all of those people, engage them early, tell them what you're doing, tell them why you're doing it, and get their buy-in early on. It's also really important to engage the finance team. The finance team are the people ultimately that will be submitting this. So we need to understand how this fits into their reporting and also how the auditors are going to be involved with this as well. Second piece you need to do is look at what you already have. So you don't want to be building a whole load of new systems unnecessarily. Look at what you have for your NGAS reporting, speak to your risk management teams if you have them, or look at existing risk management frameworks. Look at where you've already done climate change risk assessments. You may have them for planning and approvals or for some of your operational sites. Understand what you already have and use all of that. And then focus on filling those gaps. I say likely those gaps will be scope 3 and climate scenario analysis, because those are the gaps that everyone seems to have. But look at what you have and how you can build that out, and then build a plan. So this is probably a 12 to 18 month process to get ready, and you can do it faster, but I'd recommend getting started early. But also think about what this looks like longer term as well, as those assurance requirements and disclosures requirements evolve over time. Conscious of time, I'm going to jump to this as my final slide. So as I mentioned, this can take up to 12, maybe 18 months to prepare. You can condense some of this as you really have to, but in terms of the things you need to do, so as starting off with a bit of a diagnostic, understanding what you have, thinking about where those risk and governance and oversight pieces need to be filtered throughout this, and then as soon as you can, get started on that scenario analysis and then the greenhouse gas accounting piece as well. Those two pieces obviously feed into that transition plan. So if you want to progress that transition plan for year 1, you need to get started early, and then give yourself time to actually disclose as well. Write that disclosure, go through that assurance process, and get ready for that final submission.